Hello there, welcome to Lecture Series 8. This is a three-part lecture series on IAS 36, Impairment of Assets. The objective of IAS 36 is to prescribe the procedures an entity applies to ensure its assets are carried at no more than their recoverable amount. An asset is carried at more than its recoverable amount if its carrying amount exceeds the amount to be recovered through the use or sale of the asset. Note, not all assets are subject to impairment procedures set out in IAS 36. IAS 36 does not apply, among others, to inventories, deferred tax assets, investment properties measured at fair value, and biological assets, as these assets are subject to annual impairment review through the measurement principles of the individual standards. Taking, for example, investment property carried at fair value, IAS 40 requires the investment property to be measured at fair value at each reporting date, and therefore, if the carrying amount is greater than the fair value, being the recoverable amount, a fair value loss shall be recognized in the profit or loss. IAS 40 investment property was covered in Lecture Series 4 as a two-part lecture series. Please be reminded, financial assets within the scope of IFRS 9 are not subject to impairment principles of IAS 36, but those set out in IFRS 9. This means, however, investment in subsidiaries as defined in IFRS 10, associates as defined in IAS 28, and joint arrangements as defined in IFRS 11, being outside the scope of IFRS 9, shall be subject to impairment principles as set out in IAS 36. So, when should we recognize an impairment? An asset is impaired if the carrying amount of the asset exceeds its recoverable amount. Question: what is recoverable amount? Recoverable amount is the higher of fair value less cost to sell and value in use. An entity should assess at the end of each reporting period if there is any indication of impairment. IAS 36 lists the following indications that an asset is impaired. Internal source of information indicative of impairment are 1. Evidence of obsolescence or damage. 2. There is about to be a material reduction in usage of an asset. And 3. Evidence that the economic performance of an asset has been or will be worse than expected. External source of information indicative of impairment are 1. Unexpected decrease in an asset's market value. 2. Significant adverse changes have taken place, about to take place in the technological, market, economic, or legal environment. 3. Increased interest rates have decreased an asset's recoverable amount. And 4. The entity's net assets are measured at more than its market capitalization. In the case of intangible assets with indefinite useful life and goodwill, as these assets are not amortized, IAS 36 stipulates they should be subject to annual impairment tests, irrespective of whether there is indication of impairment. Part 2 of Lecture Series 8 on IAS 36 Impairment of Assets will focus on calculation and recognition of impairment loss. Till then, thank you and have a pleasant day.